It's commonly known that the most simple and hands-free way to invest in the stock market for retail investors like you and I is to go down the route of index funds or ETFs. There are literally thousands to choose from, and they're easy to manage, they're relatively low risk, and they can be a great way to diversify your investment portfolio. You don't really need to be spending time picking individual stocks to be in the game of investing. But if you're anything like me and you like to dabble in individual stocks alongside your index funds, then it's good to know a few key metrics you can use to analyze your different stock picks. I'll be covering some of these metrics in this Investing Explained series, so please do subscribe if you think it will be useful to you and your own investing journey. If you're an income investor and get really motivated by seeing dividends hit your account every few months, then you've probably come across the dividend yield metric before. Looking at the dividend yield helps us to understand how much a company pays out to its shareholders for each share they own as a dividend each year compared to its current share price. In other words, it's the ratio of dividends paid against its stock price. The dividend yield is used by investors to see the dividends they can earn on their investment in a stock and basically shows the return they're getting on their investment. This is really useful because even though investing should be a long-term gain, receiving a regular dividend from your investments can help provide you with a steady stream of passive income in the present, regardless of whether your investments are gaining some ground or they're in the red. Alternatively, if you don't need an income just yet, you can choose to reinvest your dividends back into the company or funnel them into your wider portfolio, which will help supercharge the effects of compound interest, which we all know is major when it comes to building long-term wealth. Now, the dividend yield doesn't just apply to individual stocks in a company. You can also have many index funds and ETFs that pay dividends to its investors and therefore include this metric in their key information. For example, Vanguard's VUSA or VUSA ETF, which tracks the S&P 500 index, is a dividend-paying ETF with a dividend yield of 1.34%. This means that you would have earned 1.34% in annual dividends from an investment in VUSA shares as priced at that time. You're unlikely to need to calculate the dividend yield of a stock yourself, as there are plenty of stock analysis resources that will crunch the numbers for you. You can use some of the sites I've listed in the description box below, or you might be able to use your own investing platform to find this data. I have investing accounts with Training 212 and Freetrade, and both actually offer this level of information. By the way, if you want to get a free share by signing up to either of these platforms, then I have links in the description box below that you can use to get free shares worth up to £100. If you prefer to do the maths yourself though, you can easily calculate the dividend yield by dividing the annual dividend per share of a company by its current price per share. So for example, say you have a company with a share price of £50, which pays an annual dividend equal to £1.50 per share. To work out the dividend yield, you just divide the dividend amount per share, so £1.50, divided by the price per share of £50. This gives you 0.03, which expressed as a percentage is a dividend yield of 3%. One important thing to remember when reviewing the dividend yield or calculating it yourself is that you need to be aware of what period you're looking at. Sometimes the data you find on a company's website or included in their annual financial reports could be based on a prior year. So if it's been a while since the end of the year, then you might want to look at more recent data like the trailing 12 months or TTM figure, which is basically the data from the most recent 12 months, or you can look at dividend yield data from the most recent quarter. Dividend Max is a really useful website you can use to get day-to-day and forecasted dividend yield data. So I'll leave a link down in the description below to this site as well. There really is no hard and fast rule for a good or bad dividend yield. It all depends on your own investment goals and what you hope to achieve from investing in dividend stocks in the first place. Are you nearing retirement and looking to build a reliable income generating portfolio? Or are you in the growth stages of your investing journey with a much longer time horizon to benefit from price appreciation? Average dividend yields do tend to vary quite a bit, so what qualifies as good for one type of stock might actually be a relatively low dividend yield for another stock. You might think that if a company's dividend yield is rising, then that's a good sign. Yes, it could mean that their dividend is increasing, which means more money in your pocket, but it could also be a sign that the share price of the company is declining. Because the share price element of the calculation we looked at earlier is constantly changing, the dividend yield is also constantly on the move as well. As a stock price goes up, its dividend yield goes down, and as a stock price goes down, the reverse happens and the dividend yield goes up. For investors that are looking to create a passive income by dividend investing, then a high yield is definitely a good thing. This is especially true for healthy companies that have a relatively stable share price or a share price that is trending upwards over time. This is because you want the dividend income you receive to remain at a constant level if you're relying on this as a source of income. If the dividend yield is increasing over time, then that's even better, but a downward trend could dramatically impact your income stream. If you're investing in dividend stocks or funds, then it can be useful to know what factors might impact the dividend yield when you're doing your own due diligence. One of the biggest impacts I've already mentioned is the share price. When the share price rises, dividend yields tend to fall, unless the company decides to boost its dividend payouts, which offsets the price hike. A drop in dividend yield due to a high stock price isn't always a bad thing, because it could mean investors have conviction in the company and view it as a good investment. Also, the capital appreciation you gain from the rising stock price can offset a lower dividend yield, so a declining dividend yield could work out in your favour in some cases. Industry trends and sectors could also impact dividend yields. The average dividend yield for a telecoms company like Vodafone is going to be completely different to the dividend yield of an energy company like BP, for example. So when you're reviewing different dividend yields, it's important to compare the yields offered by companies in the same industry. Or if you're looking at index funds or ETFs, compare similar types of funds. Typically, companies that are non-cyclical in nature and are always in demand regardless of what the market is doing, like consumer staples and utility companies, tend to have high dividend yields that remain stable over the long term. You also have real estate investment trusts or REITs that tend to have high dividend yields because they're required by law to pass on 90% of their income to shareholders. The growth of a company is also vital when it comes to impact on dividend yield. Typically, older, big companies that are well established and demonstrate a steady performance are more likely to pay dividends and have high dividend yields than newer, smaller companies. Businesses that are experiencing rapid growth and choose to reinvest their profits back into their operations rather than pay dividends to shareholders will usually have low dividend yields, or is often the case, they might not pay a dividend at all, so will have no dividend yield to speak of. Think of your Googles, your Amazons, Teslas, etc., all of which pay no dividends at the moment. Now, this might change in the future, but for now, they wouldn't be great options if you're solely an income investor. You might also see dividend yields become heavily impacted by the fundamentals of a company. If those fundamentals suddenly change and the health of a company is under threat, they might increase dividends to boost the dividend yield and attract new investors with an unrealistically high dividend yield. Unless the company can turn itself around and continue to support the increased dividend payout, then its dividend may not be sustainable and management will eventually end up drastically cutting its dividend or getting rid of it altogether. This is what's known as a dividend trap, so definitely one to be avoided. Understanding the dividend yield can play a role in helping you pick stocks for your own investment portfolio, but it shouldn't be the only metric you consider when choosing your investments. It's important to look at dividend yield as part of the bigger picture alongside other key metrics, some of which I talk about in this playlist here, so make sure you check out some of my other videos in this Investing Explained series. Thanks so much for watching, and I will catch you in the next video.